The Pinoy Boomer!
Hello, kaboomers! This is the Pinoy Boomer back with another video. So, guys, according to Warren Buffett, uh, to know if the stock that you're going to get from a company is good or not, we must first identify if its moat is good. So, do this to get your moat or to know if your company has a good moat by checking the following metrics in any financial website that we can get hold of. So we check its return on assets, return on equity, and return on invested capital. Now, before we continue, please do click the subscribe button and like this video to let me know if you want me to continue making this kinds of content in the future. And now back to our regular programming. So, as I've said, return on assets, return on equity, and return on invested capital, these are the three metrics that will help us determine if the company has a good moat. So, return on assets. Basically, this is the net income of a company. How much profits or how much income does a company produce out of its assets? That's what your return assets metric means. The next one, return on equity, think of it as how much profit the company produces using each investor's money. So that would be like us, the shareholders, buying their shares. And finally, how much income, how much profit that the company generates using its capital. Okay? Now, there are many figures that tells us what is the good percentage. What is the good percentage of return assets, return equity, and return on invested capital to say that it is a moat? For me, I would just simply put it at least it should be 10% or higher for me, so that I can uh, I'll not be too rigid in my investing. But that's for me. But if you're interested to know, in books and other websites, they say that the percentages should be at least 15% and above. If you're interested, okay. Now, in now let's have an example here. The stock that I'm looking right now is Figaro Coffee Group. And as you could see, Figaro Coffee Group has a return on assets of 16.55%, return on equity of 21.52, and a return on invested capital of 18.64%. Now, in terms of moats, so it passes the 10% criteria that I've set for these three, and it also passes the 15% criteria set in other books and other financial websites or financial learning websites. By the way, Figaro is a company that owns the Figaro Coffee, that sells coffees around the Philippines. Okay, but probably you are not aware that the Figaro Coffee Group doesn't only own Figaro Coffee. It also owns Angel's Pizza, which is very, very popular in the Philippines as well. In my place right now, uh, everyone is a fan of their uh, creamy spinach pizza. So, yeah. So, so in terms of investing stocks in this in Figaro, if you're just going to look at the metrics that measures the moat or the strength of the company, this is a good stock to buy. You could buy it at at its current share price if you're just going to base on the strength of its moat. Now, as like with any metric, like your PE ratio, price to book ratio, you should not compare it to a company of a different industry. You should always compare that company to another company within the same industry. Now, let's try to compare this against our heavyweight, which is Jollibee. So, Jollibee's ticker symbol, just replace it with JFC. And let's see if it has a strong moat. Okay, now let's scroll down and as we can see, compared to Figaro Coffee Group, if we buy it at its current share price, we are basically buying company with a weak moat at the moment because as we can see, the return on assets is only 2.82%. The return on equity is only 9.12%, and the return on invested capital is 5.33%. So, those figures are low. Okay? So, if we're going to invest in Jollibee with these three metrics that measures the company's moat, uh, it is not safe to invest in Jollibee at the moment at its current share price because we are not sure in the future that Jollibee will still have a strong moat. But then again, it's normal for companies to have a dip for certain years and then recovers. So if you're going to just based on the branding alone, uh, you could still consider buying Jollibee stocks, considering considering for the past how many years, uh, Jollibee has fended off McDonald's and other foreign restaurants and food chains. So at the moment, if we're going to ignore the these three metrics of measuring a company's moat, you could proceed with it. It's your money anyway. So, but for me, I will stay. I will stick with the measurements of a company's moat. So, if it's 10% and above, that's a go for me. And if I would use also the other metrics like your price to earnings ratio, your price to book ratio, uh, it will give me more picture or more data to consider before investing in a company stock. Now, guys, if you want me to give you a video on how to get these three metrics to measure a company's moat, please do leave a comment in the comment section of the video. So, this is the Pinoy Boomer. I hope I could see you guys, or I hope you could you should I hope you watch my next video on things about investing and making money and some vlogging comments on the side. Again, Pinoy Boomer signing off. Bye bye.